On October 21st, 2012, Jim Sinclair said the bullion banks would look to pull gold down one last time to allow them to reserve their own short positions in the market. Once this is safely accomplished, they will go fully long on their own positions and take the gold price far higher. Right now, the preoccupation in the bullion market is over a short-term correction and the more alarming potential for a repeat of the 30% price crash of 2008 to 2009. Mr. Sinclair seems to be hinting that this will provide precisely the environment for the shedding of shorts and the creation of long-only positions in the market. 6 weeks after Sinclair's warning, the bullion banks set the stage for a drop in the price of gold. As Reuters reported, Goldman Sachs predicts turn in gold bull market. In December 2012, Goldman Sachs lowered its 3, 6, and 12-month forecasts for gold and predicted the gold cycle would turn lower in 2013. On December 6th, ArabianMoney.net reported Goldman Sachs has put out a negative call on gold, saying that the bull market is over, exactly the sort of market maneuver predicted 6 weeks ago by Mr. Gold, Jim Sinclair. On January 16th, Goldman analysts whipped up even more fear amongst gold investors by predicting a long-term price of $1,200. We expect that gold prices will continue to trend lower over the coming 5 years and introduce our long-term gold price of $1,200 an ounce from 2018 forward. The Chinese New Year gold massacre between February 11th and February 22nd. To put their strategy into play, the bullion banks waited for Asian demand to slow during the 2-week Chinese New Year celebration, and when the Chinese New Year began on February 11th, the bullion banks began forcing gold and silver lower. The strategy worked. The Chinese New Year's rout of gold has caused nervous investors to sell and investment funds to exit their long positions and instead go short, allowing the bullion banks to exit their positions on the short side. On Friday, February 22nd, gold trader Andrew Maguire noted, "The paper market longs have been tricked into selling. Obviously, the managed money and the specs are now being tricked into short selling. Who do you think is on the long side of those trades? These bullion banks have actually successfully transferred massive short positions into very weak hands. And this next week is going to provide large short fuel above the market. As soon as this leveraged selling is insufficient to meet the bullion bank buying, which will happen, if not today, it will be early next week. The record number of gold shorts held by speculators usually presages a rally in gold prices. The gross short position held by speculative traders in U.S. gold futures and options has neared or exceeded 60,000 contracts only 5 times before in the last 8 years. Gold lift off soon? Maybe so, maybe not.